Quick disclaimer, guys. Trading is risky, and these results are for educational purposes only. Stop being the liquidity. You don't need complex algorithms to trade the open. You need to know where the money is hiding. I made $800 in 4 minutes this morning by ignoring the noise and watching this one specific level. Watch closely. Does this happen to you? You enter a trade, the market stops you out, and then immediately goes in your direction. That wasn't bad luck. That was an algorithm. Stop guessing where the trap is. Let me show you the institutional trap by ASR. This is not a standard RSI or MACD. It tracks one thing: institutional volume spikes and footprints before anyone known. Now that the chart is open, let's add the institutional trap indicator. Go ahead and open the indicator settings. You can always adjust these parameters later to match what works best for your trading style. For this video, I'm sticking with the default settings. The only change I'm making is to the volume spike multiplier, lowering it from 1.5 to 1. Sometimes less tweaking is more clarity. Let the market do the talking. See this spike? Retail traders buying on top. But look at the volume. That massive spike? That is a bank buying, then massive selling. Retailers trapped. The indicator detects this anomaly instantly. Now let's talk about time frames, because this is where things get interesting. You can use this indicator on any time frame. It really just depends on the kind of trader you are. If you're more of a swing trader, you'll probably want to stick with higher time frames. I'm talking about the daily, 4-hour, and 1-hour charts. When I backtest those, the signals don't come as often, but they're cleaner. You can clearly see where institutions might be trapping traders before the bigger move plays out. Again, this is just me testing and observing, nothing more than that. Now, for scalpers, this is where it really shines. Let's drop down to the 15-minute, 5-minute, and even the 1-minute time frame. All right, let's test the 5-minute chart. Signal pops up. Boom. Price moves about. Next signal, clean entry. That one acts like a sniper shot, quick in and quick out. What I'm noticing while backtesting is how well this catches micro traps, especially during the New York session open. You'll see price fake one direction, trap retail traders, and then snap back almost immediately. Again, I'm not telling anyone how to trade. This is purely me reviewing past price action and seeing how the indicator reacts in different market conditions. Whether you're a swing trader or a scalper, the key takeaway from this backtest is simple. Time frame matters, and context matters even more. Let the chart tell the story. I'm just replaying it. Now, the 15-minute view. This catches the big moves. It waited for the major liquidity sweep, gave the signal, and we caught the entire reversal trend. After the alert triggers, I wait for the candle to break. I don't worry about which direction at first. What matters here is that strong institutional activity is present. Once price shows its direction, I simply follow that move. There's no reason to fight the banks or the institutions. They're the ones driving the market. I'm not trying to predict or argue with price. I'm just observing where the momentum goes and aligning with it. If you found this backtest helpful, drop a comment saying BTC Live Backtest so I know what you want to see next. Don't forget to like, share, and comment. It really helps the channel and keeps these videos coming. Now let's walk through how I mark and study a trap candle on the chart. First, once a trap candle forms, I mark the high and the low of that candle. That range becomes important because it often shows where liquidity was taken and where institutions may have stepped in. From there, I usually see two possible ways price reacts. Again, this is just observation from past charts. Option 1. I wait for price to break either the high or the low of the trap candle. After that break, I drop down to a lower time frame and wait for a retest of that level. During backtesting, this helps me see whether price is accepting above or below that zone before continuing. Option 2. Instead of focusing only on the candle range, I apply a volume profile directly to the trap candle. Once that's on the chart, I mark the value area high, or VAH, and the value area low, or VAL. After those levels are marked, I wait for price to break outside the value area. Then, just like before, I look for a retest to see how price reacts around those levels. What I've noticed during backtesting is that these areas often act like decision zones. Price either respects them and continues, or rejects them and moves back into range. Again, this isn't about prediction. It's simply about marking key levels, waiting for confirmation, and observing how price behaved historically. The chart does the work. I'm just reading it. Now let's talk about targets and risk management, because this is where structure really matters. When I review past charts, I usually see two main options for setting targets. Option 1 is setting targets based on a higher time frame candle. For example, I'll use the 1-hour chart and measure the candle range. From there, I may project a 2x or even 3x move based on that higher time frame structure. This approach gives price more room to work and keeps me aligned with the broader context. For risk management, I keep things tighter. While backtesting, I place the stop loss below the 5-minute retest candle low. That way, the risk is defined on a lower time frame, while the target is based on a higher one. Option 2 is a bit more short-term. Here, both the entry and the target are based on the same time frame. This usually results in smaller moves, quicker reactions, and faster exits when reviewing price history. In this backtest, I'm focusing on the first option. My targets are based on the 1-hour candle structure, and my stop loss is managed using the 5-minute candle. Because of that higher time frame target, I'm not trying to take quick 1.5x profits. Instead, I let price play out. If price pulls back and sets up again, I simply wait for a re-entry and observe the next move. What I've noticed over time is that this approach helps reduce overtrading and keeps decisions more consistent. It's less about forcing profits and more about letting price move between key levels. Again, this is just me reviewing historical data and explaining how I manage targets and risk during backtesting. The process stays the same. Define the structure, manage the risk, and let price do the rest. One important thing to remember: always be cautious with large retest candles. In my backtesting, most of the time these candles are created by liquidity grabs, and they often end up hunting stop losses. That's why I prefer smaller, controlled retest candles. They usually give clearer reactions and better structure. Here again, I'm going long. And now, boom, the 1-hour base target is achieved. The stop loss was just 15 points, while the target reached 207 points. That's the kind of move I'm looking for when the structure lines up. If you want to see us backtest this in the live market, make sure to comment, share, and subscribe. And if you want to try the institutional trap indicator yourself, drop a comment and stay tuned. I'll launch it soon, if the response is good, and I'd love to hear what price level you think works best for this indicator.